Hello, this is Japanese Economic Review Channel. Today, we'll examine the Q4 2025 Quarterly Survey of Overseas Subsidiaries by MITI. Our focus is on how Japanese firms are restructuring global supply chains amidst geopolitical decoupling. We will explore the dynamic shifts between shrinking legacy markets and surging investments in new future hubs. Let's dive in. Here are three strategic pillars shaping this reorganization. First, the transport sector is driving aggressive capex despite falling sales. Second, we see an irreversible de-risking from China, marked by 56 consecutive quarters of employment cuts. Third, ASEAN is rapidly awakening as the new supply chain hub, fueled by explosive capital inflows. A macro paradox is unfolding. Total sales dropped 0.6% to $303.4 billion, and the global workforce shrank 1.6% to 3.99 million. Yet, capex surged 6.4% to $9.23 billion. Japanese multinationals are shrinking their current operations while accelerating massive investments into future capacity. This matrix reveals a stark contrast. China shows comprehensive contraction across sales, capex, and employment. Conversely, North America and ASEAN shine bright green in capex, up 16.8% and 25.9% respectively. Capital is clearly fleeing high-risk zones and aggressively relocating to high-growth environments. Geographic decoupling is undeniable. We are witnessing a clear shift of capital away from China, which saw a 20.9% capex decline. This capital is heavily redirected towards North America, our steady engine, and ASEAN, which is emerging as the premier alternative manufacturing base. Looking closely at China, we must recognize this is not a cyclical dip. Employment has plummeted for an unprecedented 56 consecutive quarters. Combined with 13 quarters of declining capex, this unequivocally signals a deliberate, structural retreat from the Chinese market. ASEAN is awakening. Thailand alone recorded an astonishing 45.4% growth in capex, driving the entire region's 25.9% expansion. This massive capital injection is cementing ASEAN's role as the undisputed core hub for next-generation supply chains, replacing legacy Chinese operations. North America remains our resilient growth anchor. Capex expanded by 16.8%, marking 8 consecutive quarters of growth, heavily driven by the U.S. market. While capital flees riskier regions, North America absorbs massive investments to expand stable, future-proof production capabilities. Analyzing sector momentum, transport machinery sits in a unique position. Sales are down 2.2%, but capex is up 17.7%. General machinery shows the healthiest momentum. Chemicals are contracting comprehensively, while electrical machinery maintains operations but pauses future investments. The automotive sector is the undisputed engine of this reorganization. Despite dragging total sales down, the sector aggressively increased capex by 17.7% for 6 consecutive quarters. They are sacrificing short-term profitability to aggressively retool and relocate for an EV and automated future. Globally, the workforce shrank by 1.6% to 3.99 million. This goes beyond the China exit. Sectors like electrical machinery have seen 30 consecutive quarters of employment decline. Firms are systematically shrinking headcount through continuous labor optimization and investing in automated facilities. Synthesizing these metrics, the master strategy is not a retreat, but a deliberate relocation. Japanese multinationals are dismantling legacy supply chains in high-risk areas and shifting capital to low-risk regions like North America and ASEAN to build highly automated next-gen hubs. Finally, our data provenance. All insights are derived directly from METI's Q4 2025 survey, covering 3,791 responding Japanese manufacturing subsidiaries. Thank you for your attention. I am happy to take any questions regarding this profound global supply chain restructuring. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.